Assalamualaikum and hello everyone. Welcome to my channel. Today we are going to proceed with the preparation of a consolidated statement of profit or loss and other comprehensive income. And in today's session, what we're going to do is we're going to prepare the statement of a consolidated statement of profit or loss and other comprehensive income, where the date of acquisition of the subsidiary is at the beginning of the current year. In my previous video, I have already shown you the consolidation for the statement of profit or loss and other comprehensive income for a company that was acquired in the prior period. Right? You can check the video in my playlist and you may find that. So for today, we're going to look at this situation where you have the year end, where the year end is, if you can see here, year end is on 30th of June, year 11, 2011. And if you look at the first sentence here, 1st of July 2010 is where the subsidiary were being acquired. So if having said that, what we're going to see is that it was being acquired at the beginning of the current year. So if you were to draw the timeline here, you'd see that this is the year end, 30th of June 11, and this is where we will do the consolidation on the reporting date, the current reporting date. This is our current year, and this is 1st of July 2010, which is the beginning of current year. I put here BOCY, which stands for beginning of the current year. And this is actually our date of acquisition. And what happened is that the company that acquired is Melati, acquired the ordinary shares. So the shares that were acquired are ordinary shares. 50,006% cumulative preference shares. And for the cumulative preference shares, here is a share that is having some priority rights over the claim of the dividends, where the company that is declaring the cumulative preference shares need to provide them in their financial statement. And if the shareholder does not receive the dividends this year, they have the cumulative right to receive the areas of dividend in the following year. That is in terms of the cumulative preference shares. And at the same time, the debenture was also acquired, the 10% debentures of Tanjung. So Tanjung is the subsidiary company and Melati is the parent. So here you have the issued share capital of Melati Berhad and Tanjung Berhad, which this is the value of the shares, the value or the fair value, 1.8 million ordinary shares of 1 ringgit each. This is the one in the subsidiary. Don't get mixed up the one in the subsidiary with the one of the parent. So the one in the parent, actually, this is the parent. So parent has 20,008% cumulative preference shares as well. And in the subsidiary Tanjung, the shares were 200,000 ordinary shares of 1 ringgit, and the 6% cumulative preference shares was 100,000, and the price is at 1 ringgit each. And the holding company does not have debenture, but the subsidiary company has a debenture of 50,000, 10% debenture. Okay, the 10% rate here is the interest on debenture, and the rate that comes next to the cumulative preference share here is the fixed dividend rate for the preference shares dividend in Tanjung. Whereas in Melati, the dividend rate is 8%. So that was just some kind of information. So what are we required to do? So if you look what you are required to do is, if you can go directly at the bottom here, so you would see that you are asked to prepare the consolidated statement of comprehensive income. This is actually consolidated statement of profit or loss. profit or loss, and other comprehensive income. So you are going to prepare the statement of profit or loss, but the consolidated one of the profit or loss and other comprehensive income for the Melati Berhad and its subsidiary. And the year end is 30th of June. On top of that, you're going to prepare the consolidated statement of changes in equity, where you're going to show the extract for the year ended 30th June 2011 relating to the group retained profit. So you need to show two columns. That is non-controlling interest. How much is the non-controlling interest carried forward at the end of the year, and how much is the group retained profit carried forward. Right, so that was the situation. So what you can do now is look at the information given. These are the summarized statement of income and statement of changes in equity for the year ended 30th of June. So what you can do first is to identify what is the percentage being acquired for ordinary shares, preference shares, and debenture. And for your information, I've already done that here in my template or my working section here, where if you would see, if you have calculated correctly, the ordinary shares that were acquired is 80%, right? The ordinary shares that were acquired is 80%. Therefore, the non-controlling interest is 20%. That was for the ordinary shares. Where the shares is 160,000 from 200,000 ordinary shares. So you will get 80%. So the remaining belongs to the NCI. And this is the one of the parent, which is holding percentage. And this is the one of the non-controlling interest percentage. This is for the ordinary shares. Okay. Right. The question that I'm using for your information, in case you are interested to have a copy of it, that is the question from FAR300, question March 2012, question 5. And for the preference shares, the cumulative preference shares, 6% cumulative preference shares. If you calculate it correctly, it would be having 50% because you acquired half of it. How do you know? Because if you can see here, you have the information 50,000, this one, out of the 100,000 here. So that is 50%. And for the debenture, you acquire 15,000, this one, out of the 50,000. So therefore, you'll be able to get the percentage. So here is 50%, and here is also 50%. And you're going to have to find also for debenture. Right. Okay. But debenture will have no non-controlling interest. So there is no such thing as controlling interest for debenture. So the percentage acquired for the debenture is 30%. 30%, and that is from 15,000 from 150,000. So you get 30%. Okay, done with that. So after you have done that, what we will do is we should go on doing the combination of income and expenses. So you can combine first this item, revenue, cost of sale, operating expenses, finance cost, investment income, before you do any consolidation adjustment. You can do that first in your template, and after you have done that, then we can go on doing the consolidation adjustment. And I've done that consolidation for you here, where I've already combined for you the revenue of the parent with the revenue of the subsidiary, and that has been done. And this is from this part of the question where we combine the section of Melati with the section of Tanjung. So if you do that combination, you have already gotten some marks for this particular question, if this is your question in the exam. And remember, our focus is to look at how do we treat when you have a date of acquisition at the beginning of the current year, where here it is exactly a year that you have acquired a subsidiary. So the date of acquisition again is 1st of July 2010. Right, now we are going to do the additional information that were given. So let us just do it side by side so that it's easy for us to see information here. So information number 1 is on fair value adjustment. Fair value adjustment of the asset in the subsidiary. So you can see that I've already prepared the adjustment or the workings for the adjustment here. Right. So information number 1, fair value adjustment, where the asset were revalued as follows. You are informed that it was being revalued. Fair value on 1st of July. Remember, 1st of July is the date of acquisition. Is 470,000 and 452,000 respectively for land and building. For the carrying value of the building, it was given as at 30th of June. This is on the current financial year end. Remember, it was acquired 1st of July. And this is exactly a year after acquisition. So the acquisition period or the holding period is exactly 1 year. 1 year. So the consolidation should have been done, full consolidation, because it is exactly a year. If it's less than a year, you have to do it according to the time proportion. So the carrying value of the land again is 700,000, and here you are informed that 50% of the carrying value of land and building is for building. So meaning to say that out of this 350,000 is for building, so that implies that another 350,000 is for the land. And that was as at 30th of June. Building is depreciated at 20% on net book value. So net book value is also known as carrying value, also known as carrying amount. So it means the same, where it is depreciated based on a cost in the first year, but in the subsequent year, if you follow the reducing balance method, in the subsequent year, it will be depreciated based on the carrying amount, which is the cost minus accumulated depreciation. So let's look at our working here, the one that you have here. For first that you need to do is put the fair value, one for the building, we take from here, another one for the land. And you are going to find out what is the surplus on the date of acquisition, or if there is any deficit. So what you need to do is to find out the carrying value on 1st of July. You are not given, right? So when you are not given, what you can do is you can gross up the carrying value here. So you have here the carrying value, which is 350,000. Here, 700,000. Okay, and each of it, half of it belongs to each building and land. So therefore, this one would be for land and this is for building. For land, no problem, because land is not depreciated. So if the carrying value here is 350,000, the carrying value here for land is the same, 350,000. Right, so you can straight away get what are the carrying value on 1st of July, because there is no depreciation. So if you compare with the fair value, there is a surplus of 120,000. However, for the building, you are going to find out the carrying value here is not going to be 350,000 for the building. So you are going to gross it up by using the information on depreciation. You need to gross up for 1 year. So if it's for 1 year, you just multiply by 100 over 80 after you have already considered the 20% per annum here. So therefore, that was for 1 year. So you need to do it for 2 years, you will do it again, 100 over 80. If you need to do it for 3 years, you do it again, 100 over 80. So here is only for 1 year, so I'm only doing once. So the difference is 14,500. So that revaluation surplus is not the one which happened in the current year. Again, this is what happened on the date of acquisition. So meaning that this one is not the one happening throughout the current year. So that happened immediately after the date of acquisition. So therefore, it is a pre-acquisition surplus, 14,500. So the impact is that will be actually included in the calculation of the fair value of the net asset, because you need to find out what is the non-controlling interest brought forward, as one of your workings for your consolidated statement of changes in equity. By now, you should have known that when you prepare the consolidated statement of changes in equity, you are going to prepare the workings for group retained profit brought forward. I'm talking about this part here. Let me just show you. This section here. So you need to prepare workings 2. Working 2 is on the group retained profit, right? But this one will not have the impact of the surplus. What we are going to do is this part on the non-controlling interest brought forward. Later, when you prepare this working to get this figure, I will show you how do you get this figure. You need to include the fair value surplus, the surplus, revaluation surplus, not the fair value, but the revaluation surplus for both land and building. So you need to include that as part of the calculation for the fair value of net asset, so that you can find out what are the portion relating to the non-controlling interest in the fair value of net asset on 1st of July 2010. So in terms of journal entry, it will not have any impact to the consolidated statement of profit or loss. As I have mentioned, this will have impact in the fair value of net asset, particularly the one relating to non-controlling interest. So we need to go and add in the calculation of fair value of net asset both revaluation surplus of land and building. For the building, it has some adjustment for depreciation, because the depreciation will be under provided when you have a surplus. There are actually another version of how to calculate the depreciation that has been under provided, but I'm sharing with you the easiest calculation that you can use to get the same answer. So rather than comparing the fair value and the carrying value, I straight away take the surplus and I multiply it with the percentage, since I'm only looking for 1 year. So that is the answer. So this can cut short your time. So for the surplus, we have already recorded here, but this one is actually the under provision of depreciation. So under provision, which would be 2,900. So that will be debited to the operating expenses, because this is happening in the current year. The depreciation is in the current year. And that will be credited to the equipment. So the part that you credit to the equipment won't appear, but the one that you adjust because depreciation was being under provided will appear later in your consolidated statement of profit or loss, as to be added to the operating expenses in the adjustment section. Next is the investment income. Investment income, if you look at information number 2, here. Investment income in Melati's statement of comprehensive income. This is the one, investment income. 98,000, Melati. Includes profit on sale of equipment to Tanjung. So profit on sale of equipment that is in between group member, Tanjung is the subsidiary, right? And that profit 14,000 is an intercompany transaction. Remember, consolidated financial statement won't report the intercompany transaction. So therefore that has to be eliminated. And one more is that you are informed the investment income not only include the profit on sale, which shouldn't be there, because profit on sale should normally be recorded under other income, but here it has been included in the investment income. We need to go and eliminate and remove that. That was an error actually. And therefore dividends also has been included, and dividend that were included in the investment income, that is the thing that you shouldn't report when you prepare your consolidated statement of the profit or loss, because that is intra-group dividends. However, if you have another dividends from outsider, or dividend from quoted or unquoted investment, or maybe from the third parties, shareholders, which are not the member companies, that should be reported, right? Okay, so that 6,300 will have to be adjusted. So you will need to go and debit your investment income. So I have done that here for the investment income elimination. So 14,000. So when you do that, that will be adjusted in the Sopl later. And the equipment, you won't see the adjustment in the Sopl, because equipment will give the impact in the consolidated statement of financial position. Another one is this, regarding the investment income. You also will remove there, and that will be adjusted in our working in a short while. And the interim dividend also will be removed, because you won't report the intercompany dividend. So the dividend that were included was 6,300, because that is the detail given to you, 6,003, but I have put some detail of what is the breakdown of that 6,300. You can check the working at the bottom there. And that should be what you should report in the consolidated financial statement are just the dividend that are due to the non-controlling interest, not the one due to the group member. So the next one is on debenture interest, finance costs, number 3, information number 3. You are informed finance costs are all debenture interest expense. So if you have the finance cost here, all 22,000 are the debenture interest expense. And that was under the case of, that one is under the case of Tanjung. I'm not referring to 22, it is the case here, 5,000. All these are debenture interest expense, right? And you are informed here that Melati has not recorded the debenture interest receivable from Tanjung. Recall earlier that when you acquire the debenture, the percentage that you acquire is 30%. So 30% from this 5,000 has not been credited by Melati, the parent. So that has not been recorded. So, and for your information, that should be done by Melati in its individual or in its standalone statement of profit or loss. But for consolidation purpose, we will not report the debenture interest receivable from Tanjung. So therefore, if you look here, what I've already prepared, you can check here. So the debenture interest, what you need to do is to remove the portion that relate to the parent, and you need to go and credit your finance cost to remove the one portion that relates to the parent, that is 30% from 5,000, 1,500, and investment income of Melati will still remain the same as the intercompany debenture interest income from the subsidiary has not been credited. So we will not go and record that in our consolidated financial statement. That should be recorded by the parent in its separate financial statement. Next, that will be done in our working. So later I will show you. Now I'm just going to explain the item which you have here, so that you get a better understanding of the information that are given. Now we go on to number 4. This is the easiest part, which is the intra-group sale of inventory. Identify who is the seller. Okay, the seller here, here Tanjung is the subsidiary, and they sell goods to Melati. Melati is the parent company. So it was at a markup of 25%, markup 25 over 125. And they recorded a sale of 49,500. So this is the intercompany sale and intercompany purchase. And at the end of the year, one third of these goods are still being held. So this is actually the unsold closing inventory. So therefore, you need to find out how much is 1/3 from 49,500, and then to get the unrealized profit is to find out the markup. So I've already done it here. So the seller Tanjung, buyer Melati. So eliminate the intercompany sales and purchase, debit the sales credit cost of sale, eliminate the unrealized profit, take the sale, multiply by the unsold fraction 1/3, multiply by the markup 125, you have 3,300, and that will be adjusted in your consolidated statement of profit or loss in a short while. This part is regarding dividend. So this dividend will not be recorded in the statement of profit or loss. This will be charged in the statement of changes in equity according to where it is being declared or who is declaring it. So here both are declaring. So we need to do that in our statement of changes in equity for each the Melati and Tanjung. Next one, number 6, you have the impairment of goodwill. This is no information saying that the goodwill is full goodwill or partial goodwill. So we assume it's a partial goodwill method. So it was impaired. So when it is impaired, you go and debit impairment loss. Impairment loss will be in your Sopl, and that will be credited in the goodwill. So you are done with that. And this will need to be deducted as a part of the profit deduction, but in terms of expenses, impairment will increase the expenses, particularly the admin expenses. Now we shall go and prepare the statement, but we will be doing the preparation of the consolidated statement of profit or loss in our next video. Just go and do the adjustment so that you can fill up the blank section here, and after that we will be doing all the presentation for consolidated statement of profit or loss and other comprehensive income, and also the statement for changes in equity. I will see you in the next video. I'll see you when I will see you. Assalamualaikum, and thank you for watching.